Are you ready to improve your Forex trading? In today's video, I'm sharing 8 powerful steps that can boost your trading results. No historical data or advanced tools required. These are practical and easy to follow tips you can start using right away. Let's get started. The aftermarket DR session starts the DR IDR intraday cycle and gives key insights for the rest of the day. On this day, the aftermarket DR session confirmed longs and retraced back to its mid-level before continuing higher, ending as a DR true session at 2 a.m. Here's where step 1 comes in. Always compare your analysis on the spot market chart with the currency's futures chart. Futures charts offer more accurate price action data. For the euro, use the 6E futures ticker. For the British pound, it's a 6B. For the Aussie dollar, it's 6A, and so on. If you're unsure about the tickers, you can check websites like cmegroup.com, where you'll find all the futures specifications. Switching to the Euro FX futures chart reveals something fascinating. The aftermarket DR session rejected its opening price to the tick, a small but critical detail not visible on the spot market chart. This is why referring to the futures chart is non-negotiable. Step 2 is identifying the DR model. The overnight DR session opens and closes above the aftermarket DR, signaling a possible DR upside model. How do we know? Look at the relationship between the ADR and ODR. The overnight DR session respected all ADR levels while forming well above it. This classic DR upside model suggests a bullish structure and sets the stage for potential upside movement. A quick look at the futures price chart also confirms that. As the 3:55 a.m. candle completes the overnight defining range, we move to the next step, identifying the DR box color. A green DR box forms when the closing price is higher than the opening price, signaling potential upside and increasing the probability of seeing a long confirmation. On the other hand, a red DR box forms when the closing price is lower than the opening price, hinting at potential downside and a short confirmation. In rare cases, you might see a gray DR box where the opening and closing price are equal. Here, the overnight DR box is green, increasing the likelihood of a long confirmation and supporting the DR upside model. With these probabilities stacking in our favor, we can start preparing for the next steps. Step 4 is highlighting volume and gap imbalances. Volume and gap imbalances play a significant role and can support a trade idea by helping to anticipate retracements or act as barriers for price. These details aren't visible on the spot market chart, so we switch back to the futures chart to identify them. Ideally, you have an indicator for that, which makes the process way faster. If you don't have that, no worries. You can highlight them manually. This also helps to increase the ability to spot them on your own, as they are crucial details for trading decisions. Even when volume or gap imbalances have been rebalanced by price, they can still hold importance for future price action. These areas often remain relevant, but their significance tends to diminish over time, especially when price consistently closes with full body candles through them, not just wicks. My advice, highlight even older ones and make them easily accessible to toggle on or off when needed. Categorize them by older WIBs and make them easily accessible in the TradingView object tree for reference. Here we have 2 gap imbalances from the previous day's aftermarket DR session and several volume imbalances within the current range. These areas can be helpful in decision making. The next step is highlighting previous DR levels. Here we have 4 from the previous day's price action that align with the current range. Make sure to highlight them on the futures price chart as well for better clarity. You will see why that's important as we move on with each step. These levels are important for market algorithms and give great insights into how they influence future price action. Some of them are less important than other ones. If you'd like to know all about them and many more secrets, think about joining my M7DR Academy, where I teach things that were never introduced to the retail space before. Let's move on to step 6, waiting for a confirmation. Now comes the crucial moment, waiting for a confirmation. This ensures higher probabilities of price continuing in the confirmed direction. In this example, the 4 a.m. candle closes above the DR high, providing the long confirmation we were anticipating. This increases the probability for upside price movement during the rest of the session, especially with the green DR box and DR upside model being intact as well. Always double-check confirmations on the futures chart for added precision before moving forward. Step 7 is to wait for a retracement back into the defining range. After the confirmation, we wait for a retracement back into the defining range. Clear rejections at key levels, such as the IDR mid or previous DR levels, increase the probability of a successful trade. On the spot market chart, the retracement appears weak. However, switching to the futures chart reveals a precise rejection from a previous DR session level. This is an important difference between the two charts and shows why futures charts are so valuable for Forex traders. While the 4:35 AM candle taps into the previous DR session level from the previous day's overnight DR session on the futures chart, it fails to do so on the spot market price chart. This is a crucial detail often overlooked in the spot market price chart, as DR session levels are not located exactly the same as they are on the futures chart. Always double-check these details on the futures chart for greater accuracy before making your next move. The rejection aligns with multiple confluences. A potential DR upside model forming, a green DR box with an immediate long confirmation, and previous DR levels are being rejected. With these confirmations, we are ready to plan our trade, which brings us to the last step: executing the trade. This trade setup offers almost 4R, with the stop loss placed below critical levels like the previous DR session level, opening price, and IDR mid. The target is the next standard deviation level of +1. Price pushes higher and reaches the target. Without referencing the futures chart, this high probability trade might have been entirely overlooked in the spot market price chart. The futures price chart also gives an extra confluence here. The gap imbalances were also perfectly covered with the stop loss. Preparation, patience, and alignment of multiple confluences are the keys to a successful trade. To recap, here are the 8 steps for better DR/IDR trades in the foreign exchange market. Compare your analysis on the spot market and futures charts. Identify the DR model to understand market structure. Determine the color of the DR box for directional bias. Highlight volume and gap imbalances on the futures chart. Highlight previous DR levels for additional confluence. Wait for a confirmation to increase probabilities. Look for retracements into high probability areas with clear rejections. And lastly, execute your trade with a clear plan. These steps are straightforward yet powerful when applied with discipline. If the steps don't align or fail to provide a clear picture, skip the session. Always prioritize high probability conditions. Not every confirmed DR session will turn out to be true. Backtest, journal, and study historical data. The IDR strategy provides endless data points to refine your skills. Preparation is what separates the best traders from the rest. If you found this helpful, like the video and share your favorite step in the comments, and I hope to see you in the next video.
We're gonna take on the world.